How is everyone doing? You are in the strategy room here on this Saturday night, May 3rd, 2025. I hope everyone's having a great weekend out there so far. I've got a ton of stuff here for everybody tonight. As usual, we got economic indicators. We got big stories going on. I've got breaking news from earlier today. Obviously, Warren Buffett with a big announcement that he's basically stepping down and he is going to no longer be the CEO of Berkshire Hathaway, which is pretty amazing considering the fact that he's 94 years old and he's been there a very long time. So, I have a lot of great things tonight. So we're going to jump into a lot of news stories as we always do. And then about around the hour mark, I will break off to go into what economic indicators are coming up next week. We'll talk about the episodes that came out this week. And before jumping back into some more news stories before we wrap up for tonight. But I will kick off this evening. I'm actually going to kick off with a couple of economic indicators. I want to show you guys few things here. Let me see if I can blow these up a little bit here. So I just wanted to run through a couple of these here. So this was, and we'll get into this a little bit more later as we go through some of the economic information, but I figured I'd throw some charts at you real quick. So most of the jobs added over the past 12 months are now full-time jobs. The ratio is up to about 2-to-1 as we shift back from a gig economy to creating full-time jobs with benefits. So this is an absolutely great trend. Like I said, we will talk more about the jobs numbers as we go through the evening here, but this is just a great chart that we can see right from the beginning. So now, most of the jobs added over the last 12 months are now full-time jobs. This is a great thing that we're seeing happening out there as we're beginning to see our labor market transform a little bit. This was one of my biggest gripes over the last couple of years, was that when you really broke down the numbers on the jobs reports, you saw that the vast majority of the jobs were part-time jobs, and that most of those were going to people that had, they already had, 2, 3, sometimes even 4 part-time jobs to basically try to make ends meet. So this is a great trend, and hopefully that will continue. We'll take a look a little bit later on. Stable coins on track for a $2 trillion market cap by 2028, and that's as per the U.S. Treasury. So we'll come back to that a little later. And then I just wanted to show this. So full-time versus part-time workers. So again, full-time workers plus 305,000, part-time workers plus 56,000. So again, seeing that trend going back toward the full-time workers. This is exactly what we want to see, exactly what we're hoping to see here. Here is the big one. This is the big mamma jamma. What I was saying for the last, year and a half, when you looked at the job numbers, when you broke them down, the most shocking thing was the fact that not only were you losing full-time jobs and all the job creation was in part-time jobs, but the big shocking thing was that all the jobs were going to foreign-born workers. Okay, that's where all the jobs were going, to foreign-born workers, and it was shocking. And I could not believe that every major news outlet in this country was not, that to me was the major scandal. That was the scandal of all scandals of the Biden administration, that all of their jobs were going to foreign-born workers. And I could not believe that nobody would discuss that. Only the guys here, a couple of people would talk about it, but Zero Hedge was the only one who would put up a lot of the actual numbers. And it was incredible. But here now we're beginning to see a reversal of this. So in the jobs report for this week, native-born workers plus 1 million. Fantastic. Foreign-born workers, negative 410,000. This, again, we're just beginning to go back in the right direction here. Again, this is the great thing. Native-born workers jobs plus 1 million. This is fantastic. Again, these are exactly the kind of trends that we were hoping to see here. April jobs unexpectedly jumped by 177,000, higher than all estimates. So again, great jobs number that came out this week. Federal government workers down for the fourth consecutive month from a record 2.413 million in the last month of Biden's administration. You can see kind of two charts here. The first one is federal government workers. You can see it beginning to go down. And then the monthly change, obviously 4 months basically in the red here. I imagine that those numbers are going to get a lot redder as we go through the remainder of the year. And then a note here on GDP. The best part of the first quarter GDP report was this showstopper: investment. The impetus of long-run real economic growth is skyrocketing, up 21.9% at a seasonally adjusted annualized rate. Now, obviously, we haven't talked about the GDP numbers yet. We will get into those in a little while. Obviously, not a great GDP number here for the first quarter. But if you dug into the numbers a little bit, consumer spending still holding up very nicely. Not a problem there. The big drop was in the government spending, and that's what we want. That's what we wanted to see. The other question I have is, are we actually getting a real GDP number here, or perhaps closer to a real GDP number? That is a big question that I have, because I obviously, just like with the job reports, we were seeing major manipulation in the GDP numbers, and we may still be seeing manipulation in the job reports. And I'll show you that when we look at the Zero Hedge article here in a minute. But let's keep rolling through here. So PCE price index flatlines for March as Trump slams the brakes on inflation. Monthly rate of inflation literally went down to zero, meaning the average price level of consumer products did not increase at all in March. The same was true for the core PCE price index. Amazing. So yes, and I'm going to show you guys again some numbers a little later here. We're going to look at the inflation data, and I'm going to show you that basically the trend line now for 3 months is basically that inflation is dropping through the floor. And that is fantastic news. That is exactly what we want to see. What we're going to get to here in a little while is the big question: what is the Fed going to do? The Fed, in my opinion, is running out of excuses to continue sitting on the sidelines. But Jeremy Powell, as I have said, has made this very political, and I think in certain ways has made it very personal. And he's not. I've said this before. I've been saying this for months now. He's not looking out for the best interest of the country right now. Jeremy Powell is just whatever he can do to stick it to the administration. That's what he's doing. And I hate to be that blunt about it, but that's the reality of what's going on right now. But the question is, he's not going to be able to maintain that stance forever. At a certain point, he's going to have to do something. He's going to have to act. And I think this week, we're going to talk about this a little bit more later on, but this week is going to be a huge, huge week for that. So, all right, let's continue looking. I just have a couple more of these here. While annual inflation rates were reaccelerating at the end of Biden's term, Trump has managed to bring them down fast. As month-to-month inflation collapses, the year-over-year figures are coming down too. So again, you can see here, this is the personal consumption expenditures. This is the PCE. This is a chain type price index, what they call. This is from the Bureau of Economic Analysis, or what we call the BEA. But you can see here, yeah, the inflation just beginning to come down, especially here at the end of the chart. You're seeing it spike down, which is great news. Hold on. Did no one else notice in today's GDP report that interest on the federal debt declined for the first time since? Here it's checking notes. Trump was president in 19 and 20. This is incredible news. So, I mean, as hard as that is to believe, look at the chart here. Let's look back here at 2019 and 2020. You could see the interest that we were paying on the national debt actually went down in the last 2 years of Trump's term. And then before obviously skyrocketing through COVID and through the Biden administration. But now you can actually see there's just a tiny little bit, but that interest expense, that is so what is that? So we have our national debt. We have our 36 approaching $37 trillion in national debt. And we have a cost. What does it cost us to service that national debt? Well, basically, it's an interest-only payment. So we have to pay that interest monthly and annually on the national debt. And so it's costing us a little over $1.1 trillion. That's as a trillions, $1.1 trillion to service the national debt, and that's just starting to come back down just a tad bit. Obviously, we need to get that way, way down, way, way, way down. And this is from April 30th. Inflation disappeared in March as both PCE price index and core were flat, meaning average prices had zero growth in March, much better than the rapid rise in prices we saw at the start of the first quarter in January. So again, yeah, you can see there prices really coming down. This is some home news. So 44.4% of home sellers gave concessions to buyers in March, near the highest share on record. The percentage has increased by 10 points since July of 2024 and has doubled since June of 2022. In Seattle, 71.3% of sellers gave concessions, the highest share among the 24 major metropolitan areas. This was followed by 63.9% and 56.1% in Portland and Los Angeles. This comes as home buyer demand weakened due to elevated home prices and mortgage rates, as well as rising economic uncertainty. The housing market is starting to cool down. So it's just, some interesting information there on the housing market. This I thought was funny. So Delaware is experiencing a mass exodus of companies as a result of Supreme, she's not really the Supreme Chancellor, Kathleen McCormick unhinged attacks on Elon Musk companies. The Senate introduced SB 21 to rein her in, but the bill faces legal challenges, and McCormick has reportedly chosen herself to rule on its constitutionality. I said this well over a year ago, that when this started happening, when they started messing with Elon Musk in Delaware, that this was going to come back and it was going to blow up in their faces in a major way. And that is exactly what's happening. You are seeing a lot of companies leaving Delaware. In other words, Delaware was the major state where a lot of corporations incorporated. It's where they filed, down in Wilmington, Delaware. Because there was a lot of favorable laws and favorable treatment for corporations, especially big corporations. Like if you're a C Corp, a lot of C Corps, headed there out of Wilmington, Delaware. And I again, when I saw this, I said, this is going to be bad news. It's going to be real bad news. And it's going to hurt Delaware. And sure enough, that's exactly what you're seeing happening. It's exactly what's playing out. That falls into the category of play stupid games and win stupid prizes. Okay, so let's go on. All right, let's get into some of the usual stuff here. So here is our debt clock, as I usually like to take a look at this. And we are rapidly approaching, if we look at the top left-hand corner here, we are rapidly approaching 37 trillion in national debt. We're currently sitting at 36.8 trillion. Our annual U.S. federal budget deficit is still sitting at $2 trillion, has not moved. Our debt to GDP is still sitting at 122%, has not moved. Congress just doing a bang up job there. Our Doge clock, interestingly, our Doge clock is now saying the Doge has saved us $389 million, which is a savings per taxpayer of $3,470. Now that sounds fantastic, but that's not anywhere near the number that we're actually hearing. Like, we're going to look at an article here in a second. So Elon Musk basically bidding farewell from Doge, sort of, to the Trump cabinet. He claims the Doge saved $160 billion. But as I talked about last week, we still don't know. We haven't actually seen the numbers there to justify whether or not those numbers are accurate. I don't really know where these numbers on the debt clock are coming from. I mean, Elon's claiming that that Doge has only saved 160 billion, yet we've got this 389 billion number. It just keeps ticking up here on the Doge clock. So again, not really sure where that number is coming from. I hope this 389 is accurate. That would be fantastic. But we had some very interesting developments this week. So let's take a look at this. So basically, Elon Musk bids farewell, sort of, to the Trump cabinet, claims Doge saved $160 billion. Doge chief Elon Musk claimed that his federal workforce slashed initiative so far has saved 160 billion, far less than his original projections. The billionaire Tesla CEO gave a sort of farewell to President Donald Trump's cabinet. He has said that going forward, he plans to work just 1 or 2 days a week on his Department of Government Efficiency. Musk last fall said Doge would slash at least $2 trillion from the federal budget, but later admitted that target was unlikely to be met. Then he brought it down to $1 trillion. And I said, man, if he could save $1 trillion, that would be absolutely amazing. Hasn't even come close to that. So now like I said, he's kind of stepping down. However, I don't know if anybody has a chance to see it. If you saw any of the video, they did like, I don't know if it was a live stream. I'm not sure if it was live, but they did basically a Doge cabinet meeting where Elon had a whole bunch of the Doge employees around a giant boardroom table, and they were just going around talking about their different stories and talking about different things that they found, different experiences, and different departments and different parts of the government. And it was wild. It was absolutely wild. The things that they were saying were just mind-blowing. I mean, the sheer waste that they were finding out of total, just incompetence, gross negligence. And again, I think sometimes it is hard to say that this stuff is outright fraud. I think, you have to prove that case of outright fraud. But are they finding an insane level of sheer incompetence and sheer the most horrific type of bureaucracy you could ever imagine? Yes. Yeah, there's absolutely no doubt that is what they found, and hopefully what they will continue to find. And so I just want to say this for 1 second before we go to the next story. Doge is obviously not stopping, but, and I think there's a huge but there, Doge is not who's gonna be the face or the leader of Doge going forward. I mean, if Elon's really taken this major step back, and and again, I don't know if he'll be there for future cabinet meetings. It sounds like he won't. But is somebody else going to step up and basically grab the reins here and be the front person of Doge going forward? That's kind of my big question at the moment. I think, and here's the thing. Doge has started off fantastic. They're doing an incredible job. They're showing us things that we have never in our lives seen. And they're giving us a level of transparency that we have only dreamed of. However, that being said, if Musk, is taking this major step back and he's not going to be there driving this thing, and Doge begins to kind of fade away, I'm fearful that over time, over the next, couple of years, what's going to happen is, if this is basically the best that we end up getting out of Doge, that, Doge will just fade away, and it'll just be thought of. It'll be remembered in 4 or 5 years as this great idea that failed, and I'm very afraid. I've loved what we have seen so far. I think it's absolutely fantastic. And I want them to keep going. I want them to keep going. I want them to keep digging. I mean, they haven't even really dug into the Pentagon. I would love to see a lot more from this, but we'll just have to see what happens here and how this plays out. Now, Musk did not leave without throwing some haymakers, and this was a big one. Musk says eyebrow raising. And it is eyebrow raising. 2.5 billion Fed building expansion should be subject to scrutiny. As he exited his efforts to curtail wasteful government spending, Elon Musk taking one last shot, calling into question the 2.5 billion Federal Reserve building renovation. Musk's Doge claims to have saved taxpayers 160 billion. We already talked about that. In a rare interview with print reporters, the initiator of Doge Advisory Board said the price tag for the central bank operation sounds high. I mean, what do you get for 2.5 billion in redecorating? Must be incredible, the Tesla CEO said. The Fed began the project in 2021 with an initial price tag of $1.9 billion. Since then, multiple factors have converged to drive up costs, including rising costs of materials, construction delays, changes in design, and site problems. Among the goals for the renovation are dealing with a backlog of upgrades, meeting building codes and regulations, updating technology, and addressing energy efficiency. Fed officials say the changes ultimately will save money by consolidating staff into one space, which will reduce leasing costs and provide a modern, efficient workspace for employees to conduct their work on behalf of the American people. Musk, though, said the cost overruns should be part of the broader examination of government waste. Absolutely. Doge claims to have saved, blah, blah, blah. We've got that. Since the end of the day, this is all taxpayer money. I think we should certainly look to see if indeed the Federal Reserve is spending $2.5 billion on their interior designer. Musk said that's an eyebrow raiser. They're like, can we see pictures of what you get for that? And the Fed is not actually funded by taxpayers, but rather by the interest the central banks earn on its securities, as well as fees from banks it supervises. Well, I don't know if you've seen the interest that the Fed makes on its securities, but it's negative to the tune of $315 billion right now. So the Fed's not making any money. Fed is losing a ridiculous amount of money at the moment. So spending $2.5 billion on their building, I mean, that's insane. That's just like when the FBI came and said, well, we need a brand new building. And I think, and that had a ridiculous price. I mean, I think that was like $300 million or something like that for the new FBI building, which would have been like, no. This $2.5 billion, which again is just mind blowing. What are you coating the building in gold? I mean, what $2.5 billion for the Fed building? Apple's, just I want you to think about this for a minute. Apple built the most insane headquarters I think anybody has ever seen. And I think that cost them $600 billion. And they're spending $2.5 billion on renovations to their building. And somehow, how do you say, where are the numbers on this? I really need the PhD brains. Okay. I need these amazing PhD brains at the Fed to show us the numbers that they crunched on how even consolidating people, okay, you're going to save on some leased space. In case you didn't notice, the government has a massive amount of empty office space right now. Major problem, massive amount of empty office space that they need to dump. So somehow this is going to save on lease space. How does $2.5 billion spending on renovations is going to save you some lease money like that? Those numbers aren't computing. Yes. So this, just like I said, this raises a lot of questions. And yes, I think Elon is absolutely correct. And I think that some people should be taking a look at this going, what are you guys doing over there? Because it's a very interesting question. So, okay. Big news of the day here. Warren Buffett plans to step down as Berkshire CEO at year end. Speaking at the Berkshire Hathaway's annual meeting, Buffett recommends that Greg Abel succeed him. So Warren Buffett, who is 94 years old, plans to step down as Berkshire Hathaway CEO at year end. Buffett recommends that Vice Chairman Greg Abel, his designated successor, to begin as CEO in 2026. Buffett will remain at Berkshire, but Abel will have the final say in operations and capital deployment. So Warren has been busy building this massive war chest of like $347 billion in cash. So it's kind of a crazy war chest. Here's a picture right here of Greg Abel. If I'm saying that right, Abel, who will basically be taking over as CEO. Now, I had another very interesting article that I wanted to share with you guys, but I just could not find it before we came on tonight. And basically, so Warren Buffett's son is going to be taking over as chairman. So Warren's son will be taking over as chairman, and then Greg will be taking over as CEO. I'm not sure. I didn't read through this whole article here. I don't know if they really talk about that, but they do. They do right here. So So he has said previously that Howard Buffett will eventually follow him as the company's chairman, though without an executive role. Well, what does he need an executive role for? He's chairman. He's the boss. He's the big Mahaff. If he's chairman, he's the big Mahaff. Remember, the CEO always answers to the chairman. So the next time Berkshire shareholders convene in Omaha for the annual meeting, though, Buffett would no longer be in charge. It was a special moment, the end of an era. One of the shareholders from the Bay Area in California, Buffett said he doesn't plan to disappear from the scene at Berkshire, but that under his plan, Abel would have the final say at the company. I would still hang around and could conceivably be useful in a few cases, he said, but the final word would be that what Greg said in operations and capital deployment, whatever it might be. So, yes, I mean, yeah, Warren, this is his 60th annual meeting, and it's the biggest and I think the best yet Buffett began. I mean, yes, I mean, so 60 years, man. He's been there running this company, and it's just been I think a wild ride. Buffett has just been wildly successful. And it's just, I mean, kudos to him for such an amazing run, creating the whole Berkshire Hathaway annual meeting, which is just an amazing event. One of the highlights of, kind of capitalism, if you will, every year in this country. So pretty amazing. Now I was reading this book here. This was called Buffett's Early Investments. Haven't had a chance to, this has been proven to be a very interesting book. Haven't had a chance to get fully through it yet, but I will bring that to you guys once I do. I think what I might do is I might cover this from the perspective of looking at that article. There was a Wall Street Journal article from probably about a couple months ago that basically looked at how Howard Buffett was going to come in and take over as chairman. I might do a book review on this book, Buffett's Early Years, and go into that article on Howard Buffett, and then just kind of, explain a little bit more how this is all probably going to play out. Because I think and again, I just cover that because it is major news, and I think some people will, find it very interesting. So, and let's go on with that. Let's keep moseying right along here. So, wait a minute. What do we have here? What do we have here? Ye of little faith. Trump's April tariff haul hits 17 billion, blowing past first-term records. What's that? What is that I hear? A record haul on tariffs in just the first month in April alone? What's that? $17 billion. You don't say. 17 billion, you say? Only 17 billion. Huh. Trump's sweeping new tariffs brought in a record $17 billion in April alone, a dramatic shift in trade policy with major implications for the economy, the markets, and your money. You better believe it. 17 billion, everyone, and that is just scratching the surface. And now again, what is wild about this is that you didn't hear this, and you didn't see this. This should have been plastered on the page of Bloomberg. This should have been all over Bloomberg, Fox Business, the Wall Street Journal, the Financial Times. It should have been everywhere, but you didn't see it anywhere. Why? And you have to ask yourself why. Why did you not see it? Because they don't want this to be a success. Okay, because when these tariffs start bringing in huge amounts of money, and because of the haul of money that comes in, they're able to reshape the tax structure to make taxes more favorable for the little guy. Okay. They again, the powers that be don't want to see this. They don't want this. This is the last thing in the world they want, is to be like, oh my gosh, Trump was right. The tariff thing worked. Again, they were pleading, they were ready, 2 weeks ago, 3 weeks ago, it was Armageddon. It was going to be Armageddon. The stock market was going to fall off a cliff. It's all over. Trump's tariffs are going to destroy the world. They're going to create all this inflation. Where's all the inflation, man? Where's all the inflation? Non-existent. Look at this for a second. Stocks erase tariff-driven losses, post the longest winning streak in 20 years. Oh, wait a minute. Wait, what's that? Did the market bounce right back? Oh, you mean the market bounced right back? Oh, that's shocking. That's shocking. So we saw a whole bunch of people basically short the bejesus out of the market and drive the market down for a couple weeks, and then their short positions, and then people realized, oh, wait a minute, nothing's really happening here. So their short positions got squeezed. I talked about this a little bit last week. And now they got out of the shorts, and now the market has bounced right back, and we're seeing this record amount of tariff revenue coming in, blowing the doors off like this. I mean, it's fantastic. So let's go through this. April marked a watershed moment for the Trump administration's tariff strategy as the government collected more than $17.4 billion in customs duties and certain excise taxes, nearly doubling March's $9.6 billion haul and dwarfing any revenue spikes seen during Trump's first term in office. This dramatic increase represents just the beginning of what could be a transformative shift in U.S. trade policy as the current administration pushes forward with an aggressive tariff agenda that has already contributed more than $70 billion to government coffers since the start of the year. Record-breaking revenue doesn't mean stability for your finances, not yet. I'm sorry, that's part of like an ad. So hold on a second, guys. All right, here we go. The tariff landscape is driving record revenue. So April's revenue surge came primarily from implementing 10% duties on imports from nearly every country worldwide, which took effect on April 5th. These broad-based tariffs represent just the opening salvo in what the administration has described as a comprehensive trade strategy. The record haul is predictably notable because it occurred despite significant concessions granted to major importers in the automotive and technology sectors and a 90-day reprieve for numerous countries that had been targeted for higher duties. As global trade realigns, so again, that's another ad. Signs of market adjustments are already emerging. So, and then it gets into like future roadmap, whatever. But this is the point here. Like Scott Bessent, our new Treasury Secretary, told you that we could see a raise as much as $600 billion in tariff revenue. Now, I don't know if we'll get there. I mean, $600 billion is a huge amount of money, and if you consider the fact that if you do cut deals with, if you cut deals with 90, 100 countries around the world, that's probably going to put a big dent in that 600 billion, projection. But say you could bring in $100 billion or $150 billion. I mean, that is a massive amount of money to bring in from tariffs. And that would be enormous for the economy. So, so again, great start. Now let's look. We're going to look at a bunch of articles here as we keep rolling through this, and I'm going to roll through some of these articles a little bit faster. But I just want you to begin to see what's going on here, and the reason why I want to share this is because I don't think you have been seeing some of this news out there in a lot of the mainstream media outlets. So China's factory activity slumps as U.S. tariffs take effect. So official data shows the new export orders dropped to the lowest level, excluding COVID-19 disruptions, in 13 years. So our tariffs on China are already having a major, major impact. So we're seeing right here. So China's factory activity shrank more than expected in April following 2 months of recovery. A survey showed on Wednesday suggesting the country's sprawling manufacturing industry is beginning to feel the impacts of the ongoing trade war with the United States. The country's official purchasing managers index, the PMI, declined to 49 in April versus 50.5 in March, according to the National Bureau of Statistics of China. The reading marked the lowest since December 2023 and missed a Reuters experts poll median forecast of 49.8. So again, so the official NBS data showed that new export orders declined to 44.7, down from 49 in March, its lowest level, again, excluding COVID-19, since April of 2012. So huge impact here already we're seeing on tariffs. Now, and again, that was an article from the Epoch Times. Now, this is from CNBC. CNBC says Chinese factories are stopping production and looking for new markets as U.S. tariffs bite. And this was from last Sunday, the 27th. Chinese manufacturers are pausing production and turning to new markets as the impact of U.S. tariffs sets in, according to companies' analysis. Turning to new markets. What new markets? Were they running over to Europe? Like where are they going? The lost orders are also hitting jobs and forcing Chinese exporters to try live streaming at home. Interesting. Some companies have already built businesses on other trade routes from China. Yes, you better believe that. And they're going to. And the longer China holds out on this, the worse they will make it for themselves. That's it. Because all of these people are going to move their supply chains. They're going to move. They're going to reroute to different places. They're going to work with us. They're going to work with the U.S. to reroute a lot of this stuff. That's what's going to happen. Here's another article. U.S. sanctions could lead to tens of millions of lost jobs in China. Domestic migrant workers are returning home while job seekers struggle to secure employment, according to Chinese residents. Chinese unemployment crisis is worsening, residents told the Epoch Times, as the country's exporters of consumer goods lose orders from the United States. The U.S. Treasury Secretary Scott Bessent told reporters on April 29th that China could lose 10 million jobs very quickly if the U.S.-China tariff war doesn't de-escalate, or 5 million jobs if tariff rates are reduced. In early April, Goldman Sachs forecast significant challenges for the Chinese economy and labor market, citing high U.S. tariffs, declining exports to the United States, and a slowing global economy. The investment bank estimated that China could lose about 10 to 20 million jobs that depend on U.S.-bound exports. U.S.-based economist Davey Wong said the impact may be larger because of the indirect effects on various businesses, including suppliers for export manufacturers, packaging companies, and logistics companies. It could be between 30 million and 35 million jobs, noting that the impact is lethal to China's industrial cities. Lethal. So again, I mean, we're seeing here, this is the reality. This is the impact hitting home here on China. Now, here's another interesting. I don't usually get into military stuff on here, but I wanted to. But again, I'm trying to make a point here with this. Chinese military purges hint at unraveling stability of communist leadership. Probes and removal of senior officers considered allies of Xi Jinping are a sign of pervasive corruption and ruinous political infighting. Despite securing ever greater nominal authority over the levers of power in communist China, Chinese leader Xi Jinping appears to be facing intractable and growing challenges from within the regime itself. Over recent years and months, several top officers in China's People's Liberation Army have been investigated for corruption, have been removed from their posts, or have vanished from public view. While the CCP has pursued a nationwide anti-corruption campaign since Xi took office in 2013, the recent disciplinary actions have drawn attention, given that those targeted are not factional rivals of the Chinese leader, but his close lieutenants. Now, what I want people to understand is that this China's factory activity slumps, China losing millions of jobs, and now Chinese military purges. This is all connected. These are not mutually exclusive. These are not separate things. These are all interconnected. One of the big things that I said last week was that I said Xi Jinping cannot come to the tariff table right away and cut a deal with the U.S. because he can't afford to look weak. Because if he looks weak, he could potentially get removed from power, and that's exactly what is happening here. So he is basically stuck in a. We've got them stuck in a bind. We had them stuck in the bind of all binds because their economy is getting crushed right now. And again, you also have to keep a little, you have to take the numbers that China gives you with a little bit of grain of salt. I would say whatever the numbers that they're giving us, okay, I wouldn't put a number on it, but I would say whatever they're giving us, the real number is way worse. They're going to give us something that doesn't look horrific, and maybe not great, but doesn't look horrific, when the actuality is the real number is probably horrific. And they're not going to give that to us because they know if they give us the truth, okay, that's going to give us, the US, more leverage over them, and they're not going to do that. So they're going to give us, they're going to downplay everything. Oh, it's not good. But I just want people to understand that these things are interconnected. Okay, Xi, it's the politics of it. Xi has to look strong. He cannot look weak. The weaker he looks, people are seeing this. They're seeing the effect on the economy. They're seeing the effect on the manufacturing jobs. 10, 20, 30 million potential loss of manufacturing jobs. And the unemployment rate skyrockets. And now all of a sudden it's like, now all of a sudden all the people that couldn't say anything when things were rolling good, they're all speaking up now. And they're all basically saying, hey man, you suck. You might have to go. And so of course their natural instinct is, we've got to purge. We've got to purge everybody. We've got to get anybody who might be a threat. Got to get them out of here. So again, I just wanted to point that out. Now, here's another interesting thing here. The U.S. can produce rare earths if China stops exports, but there's a catch, and it's in the refining process. We basically, because we have lost a large part of our manufacturing base, we do not have the ability to refine these things. We can dig them out of the ground, but we have the big gap in the middle, if you will, in terms of refinement. So, and this article basically goes on to make that point, to basically say China's export restrictions on 7 key manufacturing materials exposes a glaring absence of commercial processing capacity with few fast fixes on tap. So it could take up to 5 years to develop a domestic supply chain to supplant China's global monopoly in processing rare earths into materials needed to produce everything from iPhones to F-35 fighter jets. While the United States has most of the 17 rare earth elements and 50 critical minerals underground, it has no industrial capacity to refine them into processed metals and magnets, according to Melissa Mel Sanderson, American Rare Earths board member and Critical Minerals Institute co-chair. Currently in the United States, we have 0 magnet manufacturers, Sanderson told the Epoch Times. That's wild. That's wild to me. We have 0 magnet manufacturers. How is that possible? She said that that's why China imposed export restrictions on 7 heavy rare earth elements on April 4th in response to President Donald Trump's April 2nd tariff announcement that boosted levies on China imports. After tit-for-tat tariff hikes, the United States is currently levying Chinese imports at 145%, with electronics exempted for now. I certainly hope, as the administration is working through this critical area, no pun intended, it's a critical area, they realize there's this vulnerability gap, to a 4 to 5 year gap, no matter how you look at it, in terms of ramping up domestic production. Trump's April 2nd order gives Commerce Secretary Howard Lutnick 180 days to suggest how the federal government can help develop a circular domestic rare earth supply chain. So again, this is, we're seeing, this is the problem with destroying your manufacturing base over the last 40 years, because we lose this knowledge. We lose the ability to we have 17 of these rare earths. Like we've got a lot of this stuff. We can pull a lot of this stuff out of the ground, but it's that industrial refinement process. It's the middle part of the process. Okay. It's like, okay, I pulled that rock out of the ground and it's sitting here in front of me. It looks wonderful. What do we do with it? How do we refine that? How do we turn that into something that we can then use to make, like I said, make an F-35 fighter jet, make iPhones? What can we do with this stuff? So again, and this is why, like, we have to bring this manufacturing back, so that countries like China, how do we let a communist country like China get this power over this? I've been asking this question since I was in college, 25 years ago. How in the world do we allow China to get this power over us? It's just, to me, it's insane. This is why, and again, it's not about bringing, like, it's not about going back to the 1950s and getting like all that manufacturing base back, but it's about making sure that at the very least, we have enough manufacturing that if something happens, if COVID happens again, that, we're able to get the medicine that we need, that we're able to get these rare earth minerals, that we're able to generate all the stuff that we need to make all the stuff that we need, we're not, at the mercy of a communist country like China, who can basically just hold us hostage and do whatever they want to us. That's the point of all this. Like we have to deal with this issue. Speaking of U.S. manufacturing, so U.S. manufacturing shows signs of improvement as factory output and orders tick higher. So factory activity improved in April, where price pressures and uncertainty related to Trump administration's trade policies weighed on the outlook. So U.S. manufacturing showed modest but meaningful signs of improvement in April, according to data released Wednesday by S&P Global, which showed factory output and new orders ticked higher. And the April 23rd report, combined with the Federal Reserve data, suggested America's industrial sector is stabilizing amid tariff-related uncertainties. The S&P Global Flash U.S. manufacturing PMI rose to 50.7 in April from 50.2 in March, marking a two-month high and remaining just above the neutral 50 threshold that separates expansion from contraction. Factory output also returned to growth, edging up to 50.2 from a contractionary reading of 48.6 in the prior month. The improvement, though modest, points to a sector that is adapting to volatile conditions while benefiting from stronger domestic demand. The data comes as the Trump administration continues to implement sweeping tariffs as part of a broader effort to revive America's long declining industrial base. President Donald Trump's trade strategy aims to close tariff deficits, encourage the reshoring of U.S. production, and fund tax cuts through increased tariff revenue. While the policy has rattled markets, it has also begun to alter sourcing decisions and drive some gains in domestic manufacturing. And I think it's going to drive ultimately a lot of gains in in U.S. manufacturing. I think we're going to see a lot of gains in the next 3 years. How do we know that? Let's see here. What am I looking for? Where is it? No. That's not what I'm looking for. The next, hang on, hold on. This is what I was looking for right here. So, and this is the type of investment and stuff that we need to see. So IBM pledges that they're going to put $150 billion to boost U.S. tech growth and computer manufacturing. So IBM announced $150 billion investment in the U.S. over the next 5 years. The funds include $30 billion to advance American manufacturing of its mainframe and quantum computers. The company announced the Z17 artificial intelligence mainframe earlier this month. So IBM has committed to putting in $150 billion. And that goes along with a lot more. I mean, basically, President Trump has already gotten dozens of other companies to already commit to about $1.6 trillion and basically bringing manufacturing back here to the U.S. Now, of course, that's going to take a few years to kick in, but it's $1.6 trillion in money. And that was before we added an IBM. And I know he's discussing, he might add another $1 trillion to that. So he might get that up to, $2.6 to $3 trillion by the time he's done kind of with this initial surge, if you will, in the next year or so. So again, you love to see this. And this is what is going to help bring a lot of those really good manufacturing jobs back to the United States. So, all right, so let's continue. I got a couple more articles here on the whole kind of tariff ban. So Treasury Secretary Bessent says it's up to China to de-escalate these trade tensions. So Treasury Secretary Scott Bessent in a CNBC interview on Monday put the responsibility for reaching a trade agreement on China. Bessent added that many countries have put forth very good proposals on trade, and a deal with India could be announced very soon. So Treasury Secretary Scott Bessent on Monday put the responsibility for reaching a trade agreement on China. I believe that it's up to China to de-escalate because they sell 5 times more to us than we sell to them. And so these 120% to 145% tariffs are unsustainable, Bessent said during an interview on CNBC Squawk Box. The comments come with markets on edge over the direction of tariffs following President Donald Trump's April 2nd announcement. Since then, the U.S. has made progress in negotiations, Besson said, singling out India for a potential deal in coming days. Among 15 to 18 important trading relationships that are subject of negotiations. We've had many countries come forward and present some very good proposals, and we're evaluating those, he said. I would guess that India would be one of the first trade deals we would sign, so watch this space. Again, this is checkmate on China. Again, we don't have to get all this stuff from China. We can go to other countries to get a lot of the stuff that we need. So put yourself in the shoes. Say you're think about it like this. Say you're Vietnam, or you're Cambodia, or you're Thailand, any one of those countries over in Southeast Asia. If you could just take a chunk, a little piece of that business from China, that is a boondoggle for your country, a boondoggle. So again, this is why you saw countries like Vietnam and Cambodia and Thailand and India. This is why you saw them jumping. They were the first ones out of the gate to jump at this thing and say, oh, yes, United States, we'll make a deal with you, and we'll make a deal with you right quick, because they know, based on everything we just talked about with China, with the whole the military situation, the country situation, everything going on there, China's going to hold out, and the longer they hold out, the worse it will be for them, because all of these other countries will run in and they will begin taking, basically taking a bite at the apple, if you will, and they're gonna get great trade deals done. It's going to be a boom for their countries, for their economies, and they'll be happy to have it. And China will be the one that will basically take this thing on the chin at the end of the day. And that's how ultimately this thing's going to play out. Now, does that mean that China can't hurt us a little bit? No, absolutely not. I've said that before. China, we are, again, the U.S. and China are so heavily integrated, especially economically, that it is this decoupling, if you will, is not without pain. It is not without pain. But so far we're very early in this thing. But so far, this is playing out the way that we would hope it would play out, or hope you'd like to see it. So okay, let's. This was kind of a funny story. So I don't know if anybody was paying attention to this on Monday. So Jeff Bezos and Amazon, in their infinite wisdom, basically said that they were going to come out and they were going to put this label on everything sold on Amazon. They were going to, so if you went to buy, I don't know, you're going to buy paper towel on Amazon, right? Say you were going to buy a big roll, bulk 20 rolls of paper towel, right? Like what you would buy at Costco or BJ's. So they were going to put this box, so that you would come in and they would say, okay, this normally costs $20, but because of the Trump tariff, there's an extra $5 for the tariff fee. And they were going to put that in big bold on every item on Amazon. And of course, the White House immediately called and and basically said, okay, man, if that's how you want to play, this is going to go very, very badly for you. Remember, Amazon's biggest contracts are with, guess who? The government. Okay, that's the number one. Amazon Web Services. You know who their number one client is? It's the CIA. Their number two client is, guess who? It's the Pentagon. Okay, the Amazon and Jeff Bezos rely amazingly on the government. Okay, Blue Origin. Where does Blue Origin get all their money from? Oh, that's right, government contracts. Oh, I forgot. So obviously, people in the Trump administration picked up the phone and said, yeah, Jeff, you want to do this? You really want to go down this road? You really want to do this? That's fine, man. All those contracts you got, yeah, they're all going to be gone. Okay. And then we'll see what your stock price looks like after that happens. Okay. So obviously, and this all took about 35 minutes. And then immediately Amazon ran right back out and said, oh, no, we're not going to do that. We're not going to do that. It's just, man, it just, yeah. Wow. I will tell you this though, and a couple of people pointed this out, which I thought was great, is that in a certain respect, I would love to see this. I would have loved to have seen Amazon do this, because what would have happened is the net effect would have been, you would have seen how much stuff that you're buying actually comes from China. You would see the fact that like 90% of the stuff that you were buying is coming from China. And a lot of the stuff is cheap crap. Okay. A lot of the stuff is cheap crap. And and again, people, it would have woken people up to a lot of this stuff. So I don't think at the end of the day it necessarily would have been the most horrific thing in the world. But like I said, I thought it was kind of a funny story, so I just thought I'd throw that in there real quick. IBM pledging 150 million. We already talked about that. Okay, now let's get into some economic indicators here for a few minutes. So, because we had a lot of stuff this week, we had a lot of inflation. We had the GDP numbers right here, the jobs numbers. So the U.S. economy shrank 0.3% in the first quarter as Trump policy uncertainty weighed on businesses. So gross domestic product fell at a 0.3% annualized pace, largely pushed by a surge in imports ahead of President Donald Trump's tariffs. Imports soared 41.3%, driven by a 50.9% increase in goods. Imports subtracted from GDP. So the contraction in growth may not be viewed as negatively given the potential for the trend to reverse. Yes, absolutely. The report provided cross signals for the Fed. While the negative growth number might push the central bank to consider lowering interest rates, inflation readings could give policymakers pause. But what did we just say? We saw those inflation numbers go down. So again, the U.S. economy contracted. Gross domestic product, the sum of all goods and services produced from January through March, fell at a 0.3% annualized pace, according to a Commerce Department report Wednesday, adjusted for seasonal factors and inflation. This was the first quarter of negative growth since the first quarter of 2022. Economists surveyed by Dow Jones had been looking for a gain of 0.4% after GDP rose by 2.4% in the fourth quarter. Now, one thing I want to point out, a lot of people, as soon as this number came out, of course, a lot of people, recession. So I would just point out that the definition of a recession is you have to have 2 straight quarters of negative GDP growth. So we didn't have negative growth here, but it was minuscule. It was minuscule growth. It was just above negative, but it wasn't negative. But you have to have 2 straight quarters of negative growth. The funny thing is, in 2022, we actually did have 2 straight quarters of negative growth, and nobody said you didn't see again. You didn't see the Wall Street Journal. You didn't see Bloomberg. You didn't see all these guys. Oh, it's a mess of recession. This is horrible. Bidenomics is trash. Like, you didn't hear any of that. But you hear it with this. But like I said, when you dig into these numbers, you realize that, oh, wait a minute, consumer spending is still really good. Not the best, but it's doing just fine. And oh, look at that investment number that we're about to see huge amounts of investment coming in the door. That's big, so this has a potential here to turn around very quickly, which is the point of what we're seeing. Some of the other economic numbers here. So U.S. payroll growth totaled 177,000 in April, defying expectations. So non-farm payrolls increased a seasonally adjusted 177,000 for the month, slightly below the downwardly revised 185,000 in March. Again, seeing those downward revisions the month after, but above the Dow Jones estimate, 433,000. The unemployment rate, however, stayed at 4.2% as expected, indicating that the labor market is holding relatively stable. Average hourly earnings rose 0.2% for the month, below the 0.3% forecast, while the annual rate of 3.8% also was 0.1 percentage points less than expected. All right, now I'm going to come back to an article here on the jobs report just a minute. I just want to finish showing you guys these last couple of things here. So weekly jobless claims surged to 240,000, more than expected, in latest sign of economic trouble. So first-time filings for unemployment insurance totaled a seasonally adjusted 241,000 for the week ended April 26th, up 18,000 from the prior period and higher than the estimate for 225,000. Continuing claims, which run a week behind and provide a broader view of layoff trends, rose 1.92 million, up 83,000 to the highest level since November 13th of 2021. And I just wanted to see, do they have the number of jobs on the market? No. So I think number of jobs out there right now are about 7.3 million, something in that range. So again, not horrific, but maybe not as great as what should be. Private payroll growth slowed to 62,000 in April, well below expectations. So private sector payrolls rose by just 62,000 for the month, the smallest gain since July of 2024, down from 147,000 in March and missing the Dow Jones consensus estimate for an increase of 120,000. Leisure and hospitality posed the biggest gain, adding 27,000 jobs. Others that showed increases include trade, transportation, and utilities, 21,000, financial activities, 20,000, and construction, 16,000. So, and then what else we got here? Now we're getting into kind of home buyer mortgage demand. We'll come back to that in just a second. But let's go back to this for a second. So the April jobs unexpectedly jumped by 177,000, higher than all estimates. Ahead of today's job report, we knew the number would be a big drop from March's 228,000. The only question was how big said drop would be and whether a tariff hit would be accounted for in today's numbers. We got the answer moments ago when the BLS reported that in April, the U.S. added 177,000 jobs, which, while certainly a big drop from last month's 228, came in well above the Wall Street median estimate of 138 and clearly indicated that the tariff hit has yet to come. So interesting news there. While hardly a blowout number, today's print was so strong it came above the Wall Street estimate of 171K. That's what they called a 2 sigma beat on non-farm payroll from a statistical perspective. Also notable, taking a page from the Biden playbook, the March jobs report was revised dramatically lower from 228,000 to just 185,000, the third consecutive downward revision of job numbers in a row. So again, you have to ask the question, are we still playing games with these monthly job numbers? Are we still playing games here? We've had 3 straight months here of negative revisions, indicating that the employment market, while kind of hanging in there, is certainly not great and certainly not as strong as what we're looking for here. So, and again, you go back to these numbers of, again, weekly jobless claims surging to 241,000, private payroll growth slowed to 62,000. The payroll numbers being revised down from 228 in March down to just 185. And then we got 177 for this month. So again, the trend not looking as good as it should be, showing some weakness there in the labor market. And so where is this all heading? Well, you got weak GDP numbers. You got a somewhat weakening labor market. You got the whole tariff thing, and you've got inflation inflation dramatically dropping. So where is the excuse for the Fed? And this is what we're coming back to here in just a second. So I just wanted to check a couple things. So, okay, the unemployment rate was unchanged as expected, printing at 4.2% as the number of unemployed workers rose 436K to 163.9 million, while the number of unemployed rose to 82,000 to 7.1 million. Among the major worker groups, the unemployment rate for adult men, 4%, adult women, 3.7%, teenagers 12.9%, whites 3.8%, blacks 6.3%, Asians 3%, and Hispanics at 4.2% showed little or no change over the month. Another improvement, the labor force participation rate at 62.6% rose from 62.5% last month and was above the 62.5% median estimate. Thanks to the big jump in household survey, the gap with the established survey closed some more again in April. So again, this is the household versus the establishment survey. We've been seeing this gap again. Another thing that gives us an indication of manipulation with the numbers is this gap. This gap here in this survey is not normal for there to be this, kind of, giant gap here, if you will, in this. So just something to point out here. See here if there's anything else I wanted to cover here. I don't think so. Federal versus government workers. I think we kind of already looked at that. Again, the great numbers that I talked about earlier, where we're beginning to see a bigger rise in full-time workers again. Fantastic. We're starting to see that native-born workers, again, plus 1 million to the positive side. So native-born workers starting to see the bulk of the jobs again, as opposed to foreign-born workers. So that's great, great news there. And once again, got to give a hat tip to the guys at Zero Hedge. They do a fantastic job of breaking down the numbers in a lot of these economic reports and giving us what the real representation of these numbers are. So, hat tip to them for doing that. So, okay, now let's just jump back to this for just a second, because we're going to come back to the Fed here in just a minute. So, home buyer mortgage demand drops further as economic uncertainty roils the housing market. Now, we looked at a chart at the very beginning here tonight on what was going on with the housing market. We saw in certain parts of the country, like Seattle, Portland, California, really starting to see a softening of the home and mortgage markets. So the average interest rate for 30-year fixed rate mortgages with conforming loan balances decreased to 6.89 from 6.9%. Even with rates much lower than a year ago, potential buyers are hitting pause. Applications to refinance a mortgage were still significantly higher than they were at this time last year. So refinancing activity seeing a little tick up. Mortgage rates didn't move much last week, but home buyers continued to pull back amid concerns over the broader economy. Applications for a mortgage to purchase a home dropped 4% last week compared with the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. Volume was just 3% higher than the same week 1 year ago, even though interest rates last year were considerably higher. The average contract interest rate for 30-year fixed rate mortgages with conforming loan balances, which is $806,500 or less, decreased to 6.89 from 6.90, with points increasing to 0.67 from 0.66, including the origination fee for loans with a 20% down payment. That rate is 40 basis points lower than the same week 1 year ago. So that's obviously good. Mortgage application activity, particularly for home purchases, continues to be subdued by broader economic uncertainty and signs of labor market weakness, dropping to the slowest pace since February, said Joel Kahn, Vice President and Deputy Chief Economist at the MBA. With slowly increasing housing inventory in many markets and first-time home buyers still in the mix, FHA purchase applications fared better with only a slight decline. Applications to refinance a home loan dropped again 4%, and were 42% higher than the same week 1 year ago. So we are seeing a little bit of refinancing activity. Obviously, what would be amazing is if the Federal Reserve would start beginning to decrease interest rates, and that's the big question here. What is the Fed doing? So. And again, we talked about, stocks a little bit earlier, stocks jumping back dramatically here, which is fantastic. And then some of the inflation numbers here. So here we go. Inflation, inflation was tame in March, but tariffs cloud the outlook. Let's see here. So the consumer prices stayed flat in March, in line with forecaster expectations, as a drop in gas prices kept overall inflation tame. Wednesday's report on the consumer personal consumption expenditures, or the PCE, otherwise known as the Fed's preferred inflation index, provided a snapshot of the economy. Consumer spending jumped to 0.7%, a larger than expected increase as people raced to buy things before tariffs took effect. I want to say something about that for just a second. Now, I don't know about you guys out there, but, my spending habits in the last, couple of months or since this tariff announcement have not changed. Not one bit. I go to the grocery store every week, buy the same stuff. I go to BJ's a couple times a month, buy the same stuff. Haven't really changed. Haven't really, again, that's not to say that we couldn't see some tariff pricing or some some adjustments in pricing on things, over the next 6, 7, 8 months. But I'm just saying this. I think this idea that, oh my gosh, all these people are racing out to do stuff before the tariffs. I mean, I'm not racing out to do stuff. I'm not. I mean, are you guys? I love to see if anybody has any comments on that one. But so again, just kind of interesting there. But consumers' prices, again, stayed flat in March after rising 0.4% in February, as measured by the PCE. The Bureau of Economic Analysis said Wednesday prices rose 2.3% over the past 12 months, the lowest annual inflation rate since October. The data was broadly in line with forecasters' prediction of a 0% monthly increase and a 2.2% annual increase, according to the survey economists. Again, what's the Fed's magic number? 2%. 2%. We seem to be getting awful close to that 2%, right? And we had a 0% increase here. That's fantastic. That's fantastic. So now let's take a look at some inflation numbers. So this is the so there's three key inflation gauges, everybody. There's the CPI, there's the PPI, and then there's the PCE that we just looked at. So this is the CPI index, and this is from the St. Louis Federal Reserve, their FRED database, which is phenomenal. Love it. But here's the 1 year on the CPI. And you can see we're going down quite nicely. Now, we can see from February. Now, this is core CPI. So this is everything, or I should say this is core, meaning less food and energy. So, but you can see here, what do we have? We have a 3-month trend here going from 3.6 to 3.5 to 3.25. So if the inflation is coming down, that's the CPI. Now here's the PPI. Again, if we can look at this red line here, where are we at here? We're dropping here. So this is the total PPI. Look at that dramatic drop here over the last couple of months. So from January 0.6 down here to negative 0.4 in March. So again, it's the trend. The trend is all of these inflation numbers are coming down. Oh, here's the PCE. Oh, what do we see here? PCE and core PCE coming down dramatically, approaching the 2% threshold here. So again, it's about, again, you can't look at one of these things by itself. You look at them all together and you see that between the PCE, the CPI, and the PPI, all of the inflation gauges are telling us over the last 3 months, inflation is dramatically coming down. And it's getting very close to the Fed's preferred inflation index. And let's see here, because I just want to get through a couple more things here, guys, because I do need to stop and talk about the episodes and things and what we have coming up for next week. So this I just thought was funny. So Trump trade advisor Peter Navarro brushes off GDP drop. We really like where we're at right now. And I would say yes. White House trade advisor Peter Navarro downplayed the unexpected drop in the U.S. gross domestic product last year. We really like where we're at right now, Navarro said, pointing to a surge in domestic investment revealed in new data released by the Commerce Department. Navarro is an ardent supporter of the Trump's tariffs. Yes, so I got to say just one thing about today's news. That's the best negative print I've ever seen in my life, Navarro said on CNBC's Squawk on the Street after the Commerce Department reported that GDP fell at a 0.3% annualized pace in the fourth quarter of 25. The markets need to look beneath the surface of that figure, said Navarro. We had a 22% increase in domestic investment. Yes, that is off the charts when you strip out inventories and the negative effects of the surge in imports because of the tariffs. You had 3% growth. So we really like where we're at right now. Yes, I would say I would absolutely agree with that. On a side note, I just want to say Peter Navarro, being a business, banking, economics guy, I love Peter Navarro. I've been reading Peter Navarro's stuff since I was in college, and I can't even tell you how upset I was when he got put in jail. Beside myself. This man is an economist. Okay, all he's ever done was work on business and economic issues, whether it was in private practice or whether it was for the White House. The fact that they put this man in jail was a disgrace, absolute disgrace. And again, I'm not going to get off on a huge tangent on it. I wanted to say that. I wanted to say my piece that it just, Yeah, it really made me mad. This was a 70-something-year-old man who was a Harvard economist, Harvard man. Okay, they stuck him in jail for 4 months. It's ridiculous. Anyway, I digress. Okay, let's continue on here. Okay. Now, here's where we get to the Fed. So now the Trump calls on Fed once again to lower rates after solid April jobs report. So President Donald Trump issued the latest call for the Federal Reserve to lower interest rates following a better than expected jobs report for April. The Bureau of Labor Statistics reported, again, we saw that a job number is up to 177,000. Trump's Truth Social posts show him scaling back his criticism of Fed Chair Jeremy Powell. But again, Trump tweeted, just like I said, and we're only in a transitionary stage, just getting started. Trump wrote in an exuberant Truth Social post minutes after the latest non-farm payroll data came out. Consumers have been waiting for years to see pricing come down. No inflation. The Fed should lower its rate, he said. And again, it's getting hard to like 3 months ago when Trump said that, I was kind of like, yeah, I don't know. I don't know about that because we saw the Fed begin to the Fed definitely lowered rates too soon. They lowered rates because of the minute they lowered rates, we saw a pop in inflation, and then they backed off and said, okay, we got to hold off. But now you have all these new policies that are being put in place. You have a much different economic agenda at play, and it's only in the beginning stages. But we're already seeing some net effects of what's going on. And what's being put in motion. And the Fed is basically, they're running out of excuses here at this point to be sitting on the sidelines. So with that being said, we go to, oh no, what happened here? There we go to this article. What to expect from Wednesday's Federal Reserve meeting. So what can we expect here? So let's get down here. So the Federal Reserve is widely expected to hold its key interest rate steady on Wednesday as officials wait to see how President Donald Trump's tariffs will ripple through the economy. Financial markets are pricing in the expectation that the Fed will begin to cut rates in July. That is big. That is big because Goldman Sachs, JP Morgan, a lot of these guys were basically saying that they thought that the Fed would cut rates later this year. Probably, they're looking at, maybe September at the earliest, but more likely probably October, November, December, somewhere in that time frame for when the Fed may start cutting rates. Now it's July. Okay, that tells you right there that the markets have spoken and are basically saying they're looking at all that economic information that we just looked at, and they're going, okay, GDP is weak. Job market is it's kind of teetering there a little bit. Inflation is dramatically coming down over the last 3 months and heading in the right direction. And very soon, in the next couple months, it will be, by July, it will be back down to 2%. So at that point, okay, Fed, what's your excuse? What's your excuse for not lowering rates at that point? So like you said, so if you're waiting for borrower costs to come down, the Federal Reserve is unlikely to make those dreams come true, at least at its next meeting on Wednesday, which I would agree with. I would basically say I would not expect the Fed to do anything next week. I think that they will, and again, I think they're going to punt. I think they're basically to say, Jeremy Powell's going to come out there and he's going to make a million excuses. He's going to say, well, the tariff thing, we still need to see how things play out. The job market's great. And, we still need to see where inflation's going to go. I mean, you guys can mark me on this. Okay. I guarantee it verbatim. That's exactly what he's going to say. And he's going to come out and he's like, well, I don't know what we could do, blah, blah, blah. It's I could write the script for this stuff, man. I think I could have been a good script writer once upon a time. But yeah, so don't expect anything magical. But here's the big thing. What do we really want to see? What we want to see is what the Fed describes as forward guidance. We want to see what is the Fed going to tell us about what are they going to show as what their potential next move is? Will they signal that they may start cuts sooner rather than later? Will they signal that maybe during or by the end of the summer they're going to actually do something? That's the big thing that we have to key in on and see ultimately what comes of this, and so that's the big thing that I'm going to be looking for. Are we going to get any signal next week as to what the Fed is going to do in the next, 3 or 4 months? That's the big thing I'm looking for. So again, not expecting them to cut rates, not expecting to do anything on next week at this meeting coming up. But like I said, I'm looking for the forward guidance. I'm looking for what are they saying they may do. That's the big thing I'm looking for there. And I expect Jeremy Powell to come out with 1,000,001 excuses, and then we'll go from there. So, okay. So I want to look at something, but we're going to come back to this in just a second. All right, we're going to come back to, I got a couple things here to show you guys. Oh no, what happened there? I'm going to come back to this, show you guys this in just a second. I think I messed something up there for a second. So, okay. All right, let's come back to this. Okay, couple things I always like to do. I always like to give everybody what are the economic indicators coming out this week? And then I like to talk about what were the episodes that I put out this week, Monday through Friday. So for anybody who doesn't know, I put out an episode every day, Monday through Friday at 12 noon. Episodes are usually pretty short. They're usually about 10 to 20 minutes in length, depending on what the topic is that I'm covering. But I like to give people something that's digestible, and I like to cover basically certain reports that come out, or certain topics that I feel like might take too long in the live stream. Because in the live stream, I like to move. I like to move rather quickly. I might spend a couple minutes on something, but I'm not going to spend 10 minutes on something. I like to keep things moving along here. So I like to break up those individual topics in the episodes that I put out during the week. So, okay. So let's do the economic indicators. So what do we have coming out this week? So on Monday, May 5th, we get the services PMI, we get the ISM non-manufacturing PMI, we get the 3-year Treasury note auction. On Tuesday, May 6th, we get the trade balance, we get the 10-year Treasury note auction, we get the Atlanta Fed GDP now numbers, and then we get the API weekly crude oil stock. On Wednesday, May 7th, we get the FOMC statement at 2:00. That's what we're all going to be waiting for. The FOC interest rate decision also at 2:00, and the FOMC press conference at 2:00. And then at 3 p.m., we get consumer credit. Then on Thursday, March 8th, we get continuing jobless claims, initial jobless claims, and the 30-year Treasury bond auction. On Friday, May 9th, we get the FOMC member Williams is going to speak at 11:30, and then we get the U.S. Baker Hughes oil rig count at 1 p.m. So obviously, a lot of economic data coming out again this week, but Wednesday, May 7th, the Fed announcement and their press conference, that's going to be the big thing. That is going to be the big thing for the week. So, all right, let's put that down. So now, what did I have come out this week in terms of episodes? So, okay, so on Monday, I did episode 372, which I reviewed the FBI's 2024 Internet Crime Report, which is a very interesting report. So this report comes from the Internet Crime Complaint Center, or known as the IC3. The report shares that there were over 800,000 plus complaints filed with losses exceeding $16 billion in 2024. The top 3 cybercrimes were phishing/spoofing, extortion, and personal data breaches. So the report provides basic statistics and goes deeper on elder fraud and crypto fraud. So a lot of interesting crypto fraud in that report. So if you're interested in that one, check it out. But I thought there was a lot of really good tidbits and a lot of tips on things that you should look out for or be on the lookout for. Obviously, email, the phishing, the spoofing. I've done a couple other episodes in recent weeks on how AI has been used to kind of boost what is being done with a lot of these email phishing and spoofing type fraud schemes. So again, check some of those episodes out if you haven't seen them. Then on Tuesday, I did episode 373, which was called How Are Core Providers Performing? So the episode looked at a recent blog post from the PCBB titled Core Providers Beefed Up Tech, but Satisfaction Can Improve. So banks are happy with their core providers for the most part, but customer service and relationships can be an issue at times. And there are many reasons why a bank would not switch their core provider. But if you were thinking about switching, the blog post provides 6 factors to consider. So a very interesting post for anybody not in banking, for anybody who does not understand. Every bank has what's called a core provider. It is basically the software company that provides the core operating system, if you will, that a bank uses to run everything that it does. If open checking accounts, open loans, do the maintenance of all those loans and checking accounts, process all the things that you ask, all the debits, all the credits, everything that runs through your bank account gets processed through the core system. And there's a couple main companies out there. There's Jack Henry, there's Fiserv, there's FIS. Those are your main core providers. I would say they probably have 70% of the market share amongst all the thousands of banks out there in the country right now. So again, understanding what's going on with the core providers. Are banks happy with them? Is the customer service good? Is the product good? Why would banks want to or not want to switch from their core providers? So that is a huge topic in the banking business, and something that a lot of people, should be looking at all the time. Okay, then on Wednesday, I put out episode 374, which was Why Are Community Banks So Trusted? So in this episode, examined an article from Independent Banker magazine, which was titled, What Makes Customers Trust Community Banks? Community banks are built on a relationship-based business model. They are very active in their local communities. They donate money to charities, nonprofits, and other causes, and they position themselves as a trusted advisor with their clients and always put the customer first. And again, I could have talked to other things. There's all kinds of surveys, like the Federal Reserve, for example, does the Small Business Credit Survey on an annual basis. That survey gives all kinds of information on different, gauging different trust factors amongst like banks versus credit unions versus online lenders. And every year, banks, particularly smaller community banks, are always at the top of the list. They always maintain a 60 plus percentage ratio of trust among their customers, which is the highest among anybody out there. And these are the reasons why. And so I thought this was a really good article, basically getting at the heart of what's going on there. And that is the fact that community banks, they base everything they do off of a relationship-based banking model or business model, and that's their secret sauce. That's the key, if you will, to their success, is having a relationship-based business model, building relationships with their customers, being a trusted advisor, and maintaining an impeccable reputation. That's the key to it. So again, great article. I thought it was a very interesting episode. So again, might want to check that out. Then on Thursday, I did episode 375, which was a review of ICBA's advocacy in action for the second quarter of 2025. So, so what this is basically, this is a 2-page PDF that the ICBA, the Independent Community Bankers Association, the ICBA, puts this out every quarter, and it basically just highlights what are the top regulatory issues going on in the banking industry. What are things that are coming through? What are things that are coming up? What are things that people should be concerned with? And what are maybe some of the wins that banks have gotten recently? Now, there has been a ton of regulatory changes since the Trump administration took office in January. So we talk about, what are the major regulatory concerns for the banking industry right now? What are community banks most concerned with? And, there has been a lot of wins on the regulatory front in just the last 3 months. I think it's been extraordinary. The 180 that we have seen in the regulatory community, I think it's fantastic. I think it's really going to help banks over the next couple of years, really get back to, generating some really strong profits. And, but we'll see what happens. But again, if you're just interested if you want something that's a quick episode that basically can give you a quick snapshot on what's going on with as far as regulation in the banking industry, check that episode out. You'll learn everything you need in about 15 minutes. Okay, and then finally, yesterday on Friday, I did episode 376, which was reviewing NACHA. It's my favorite acronym to say, the NACHA. for first quarter 2025, their ACH network report. So NACHA stands for the National Automated Clearinghouse Association. They basically run the ACH for the entire country. So the ACH report, this is a quarterly report that they put out, and they put it out as basically as a really cool infographic, which I love to basically break down. And so the ACH network showed gains in standard and same day ACH during the first quarter. ACH payment volume rose 4.2% to 8.5 billion. And the report covers a number of ACH network related statistics. So again, if you're interested in learning a little bit more about one of the main payment channels, if you will, in the banking business, go check that out. And so those were the episodes for the 5 episodes for last week. I will have 5 more episodes again coming out this week. Again, they all come out Monday through Friday at 12 o'clock. You can find those episodes on YouTube, Rumble, or any of the major podcast platforms. If you subscribe, you might get notifications that tell you exactly when those episodes are coming out and what they are. So just a hint, subtle, very subtle hint. Okay. Now, let's run through some banking news, shall we? Let's run through some banking news here for a few minutes, and then we're going to get back to, I'm going to wrap up with probably about 5 or 6 more articles, and then we'll call it a night here. So, okay, so, well, a lot of economic indicators, we already went through this. One thing I did want to say, construction spending. Construction spending declines in March. So construction spending decreased 0.5% in March, but remained up 2.8% from a year ago, the Commerce Department stated. So just, like I said, just want to make a note of that. So tax foundations. So states lose when credit unions acquire banks. So for anybody who doesn't know, there's been a lot of pressure on credit unions for the last few months. The idea so credit unions over the last couple of years have been buying a lot of banks, and a lot of banks have basically been saying, wait a minute, these credit unions are getting very big. They have this tax exempt status that makes it an unfair competition. Credit unions are really not credit unions in the traditional sense anymore. They're basically operating just like a bank does. And so the question becomes, if you've got a bank that's $3 billion and you got a credit union that's $3 billion in assets, why does this $3 billion credit union, if they're both basically operating in the same fashion, doing the same thing, offering the same services, why does this credit union over here get to have this major tax exemption, which gives them a huge competitive advantage over the bank right next to it? Like, a lot of people starting to look at that and basically question that and saying, hey, this might need to change. And I think it does need to change. But basically, so this new blog from the Nonpartisan Tax Foundation notes that when a credit union acquires a bank, state and local governments can lose much of the tax revenue that the bank was paying. Yes, absolutely. So a tax preference originally designed to level the playing field now has the opposite effect, creating preferences for one class of financial institutions. The pace of acquisitions signals that credit unions are no longer alternatives to banking, but competitors with similar product offerings and client bases. Ending credit union tax exemptions would help protect local and state coffers. Yes. Continuing this theme, former NCUA chair, challenges ahead for credit union industry. So credit union tax and regulatory exemptions have become increasingly vulnerable on Capitol Hill as lawmakers consider new tax legislation. Former National Credit Union Administration Chair Todd Harper said. So let me ask you this. If you're the government and you're looking for a quick and easy way to raise taxes and get some more tax revenue in, but you don't want to tax you don't want to tax the citizens out there. Maybe you don't want to tax small business or big business, whatever. Hello, credit unions sitting right there. You've got, $7 billion, $10 billion size, asset-based credit unions not paying taxes. How about you go tax it? That is easy pickings, man. That is what you call the low-hanging fruit. That is the low-hanging fruit out there. So obviously, I think for the first time in a long time, credit unions are very scared that their tax exempt status may go away as it should. Okay, so the ICBA wrote an op-ed basically saying consolidating the federal home loan banks would harm Everyone, yes, I agree with this. I've been saying this for over a year. Leave the federal home loan banks alone. And I covered this in a couple episodes that I've done over the last 6 months. But yeah, leave the federal home loan banks alone, man. They do a great job. They've only done good things, and just if it falls in that category, if it's not broke, don't fix it. Leave them be. So okay, acting controller says AI can expand the reach of banks. So acting controller of the currency, Rodney Hood, said AI has tremendous potential to help banks optimize processes and promote access to banking services, but it must be used in a safe, secure, and trustworthy manner. Yes, yeah, you can all see that. Community bankers urge tailoring regulation at House hearing. So Michael Radcliffe, chairman and CEO of Community Financial Services Bank in Benton, I think that's Kansas. I think it says Kansas. Testified before the House Financial Services Committee Subcommittee on Financial Institutions. In his testimony, Radcliffe outlined the consequences of excessive regulation, noting rising compliance costs make it difficult for community banks to compete with larger institutions that benefit from economies of scale. Many community banks are forced to merge or be acquired, reducing financial diversity. As consolidation occurs, rural and underserved areas lose access to the personalized financial services that only community banks can provide. Yes, so what he's talking about there is a concept known as a banking desert. You might have heard of this concept of a food desert. In other words, you don't have a food store in your local community. You got to drive to the next community, or you got to drive, 30 minutes or 50 minutes or an hour away to get to a food store. Well, the same thing is happening in banking. You have states like Montana, North Carolina, where you have literally these banking deserts where you don't have a bank for 30 miles. You got to people have to drive a long way to get to a bank. So that's what he's talking about, the repercussions of over the top regulation. Now again, not saying no regulation, not being anti-regulation, just saying we want smart regulation. We want balanced regulation. We want regulation for, that makes sense depending on the size of the bank. Like, in other words, JP Morgan Chase should, a $2 billion community bank should not be looked at in the same way that JP Morgan Chase is. You need to have, different levels of regulation for different size banks, right? Okay, CFPB to deprioritize the 1071 enforcement for entities not protected by the court order. So the Consumer Financial Protection Bureau announced that it will deprioritize enforcement of its 1071 small business lending rule for entities not currently protected by a Fifth Circuit court order. The agency said it will instead focus its enforcement and supervision resources on pressing threats to consumers, particularly servicemen and veterans. So the U.S. Court of Appeals for the Fifth Circuit on February 7th granted a request by the ICBA and other litigants to suspend implementation of the rule pending their ongoing legal challenge to the rule. In granting the motion to stay, the court ordered that deadlines for compliance with the rule are hereby tolled or paused, but only for plaintiffs and interveners in this case. So yes, so we have to see how that case plays out. But again, great news. I consider that a win. So yes, hopefully that 1071 rule gets overturned. West Virginia community bankers credit union acquisition bill signed into law. So the community bankers of West Virginia endorsed a bill to restrict credit union acquisitions of banks. This was signed into law by their governor, Patrick Morrisey, a significant advocacy success for the state's community banks. Yes, I would say so. Court puts the overtime rule case on hold. So the Court of Appeals for the Fifth Circuit in Texas stayed the Texas and Plano Chamber of Commerce versus the DOL litigation challenging the Labor Department's 2024 overtime rule for 120 days. The Department of Labor requested the case be held in abeyance while it reconsiders the rule. The DOL is to provide a status update every 60 days. So again, we'll see what happens with that. And then FinCEN proposes rule to combat cyber scams and heists. So the Financial Crimes Enforcement Network proposed prohibiting U.S. financial institutions from opening or maintaining accounts for on behalf of a Cambodian group that deals in crypto scams and designating the organization as a money laundering concern. So FinCEN saying Cambodia-based Huan Group serves as a critical node for laundering proceeds of cyber heists carried out by North Korea and a transnational criminal organization in Southeast Asia, perpetrating convertible virtual currency investment scams such as pig butchering. So, yes, very interesting stuff there. So, okay. All right, so just something I wanted to read to you guys here. This was from Emily McCormick, who is the Vice President of Editorial and Research for Bank Director. And this was just they do like weekly blog posts there. So I just thought that you guys would find this interesting. So, but particularly on the Fed conversation that we've been having throughout the live stream here tonight. So, President Donald Trump ramped up and then quickly dialed back his attacks on Federal Reserve Chairman Jeremy Powell this week. There is virtually no inflation, wrote the president on Truth Social on Monday. There can be slowing of the economy unless Mr. Too Late, a major loser, lowers interest rates now. Now, obviously, Mr. Too Late, the loser he was referring to was Fed Chairman Jeremy Powell. The administration has been reportedly exploring how to fire that major loser, Powell, according to Kevin Hassett, the chair of the White House National Economic Council. In remarks on April 16th, Powell indicated a need for greater clarity before shifting monetary policy, noting that inflationary effects of recent tariffs. By Thursday, when this newsletter was prepared, the president's appetite to remove Powell appeared to have waned. I have no intention of firing him, Trump told reporters. Fed chairs have never been immune to political pressure. Yes, this is absolutely true. So Richard Nixon encouraged his appointee Arthur Burns to push for a lower discount rate ahead of the 1972 election. That rate was more important to monetary policy than it is now, wrote Burton Abrams in the Journal of Economic Perspectives in 2006. Good, Nixon replied when Burns got the rate lowered to 4.5%. You can lead them, just kick them in the rump a little. Interest rates later skyrocketed under Fed Chair Paul Volcker, who was appointed by Jimmy Carter. Volcker was reappointed by Ronald Reagan, whose administration privately pressured him not to raise interest rates ahead of the 1984 election, according to Volcker's memoir, Keeping at It. Publicly, Reagan carefully criticized monetary policy during the 1981-82 recession, but when asked about calls for Volcker's resignation at a January 1982 news conference, Reagan said, "The Federal Reserve System is autonomous. There is no way I can comment on that." Reagan ultimately backed an independent Fed, said his former Secretary of State, economist George Shultz, in a 2000 PBS interview. To do something difficult, even if you are the independent Federal Reserve, it makes a huge difference if the president is on your side and is strong and understands the problem. So I thought that was very interesting comments for a couple of things. First of all, Nixon did pressure Arthur Burns in 1972 to lower the rates. And that was a major, major mistake because it kicked off a major bout of inflation in the 1970s, which ultimately led to Paul Volcker having to jack interest rates back up to break the back of inflation, which led to the major recession that we had in 81 and 82 that Reagan was complaining about. But of course, by the end of 82, we could see that the increase, the jacking of interest rates by Volcker had worked. We had broken the back of inflation. Inflation started to dramatically come back down. And by the time Reagan got reelected in 1984, he looked like a genius and won in one of the largest landslides that this country has ever seen. And Paul Volcker was allowed to remain for a while until he was eventually booted out after 8 years and replaced with Alan Greenspan. Now, what is interesting, what she does not remark on in here is the first George Bush, George H.W. Bush, I think it was right, 41. When he went for re-election, he was heading into a recession. And he had asked Alan Greenspan to once again decrease interest rates, just as Richard Nixon had done. However, Alan Greenspan did not like George Bush. And so Alan Greenspan said, forget it, I'm not going to decrease the interest rates. And thus, George Bush did not win re-election. She failed to mention that in here. And what I find very interesting at the end is this idea that, Reagan backed an independent Fed. And to do something difficult, even if you are the independent Fed, it makes a huge difference if the president is on your side and is strong in understanding of the problem. Well, I would say I would say something different there. I would say that door swings both ways. It is also would be good for the Fed. The Fed president is on your side, meaning that the chairman of the Fed is on the president's side, and that the chairman of the Fed understands the problem and is doing things to fix the problem. This is not a one-way street where it's all on the president to be, the president needs to be so understanding of the Federal Reserve all the time. The Federal Reserve has messed up so much. We can't. We can't even begin. I've been very critical of the Fed, and I think rightly so. I think their track record proves me correct 100% of the time, all the time, because their track record has been atrocious. So again, I just thought that was a very interesting blog post because it points out that over time how, Fed presidents, they aren't immune from political pressure, and they can come under pressure sometimes. And, and this is played out in many different ways. But this idea that somehow that the Fed chairman is always correct and the Fed is always right, and that they should never be questioned or should never be pressured to change their direction. That's just nonsense. That's just absolutely nonsense. I think that the Fed and the Fed chairman should be called out like anybody else. And I think the president of the United States should be able to fire the Fed chief whenever they want to. And that's not for Donald Trump. I've said that's for any president. I think any president, if they're not happy with what the Federal Reserve is doing or how the Federal Reserve is doing things, I think they should be able to fire the head of the chairman of the Federal Reserve, just like anybody else who runs any other department in the government. But the Fed is part of the government, right? Right? At least that's what we've been told. We'll save that gem for another time. All right. Let's get a couple things in here before we wrap up. So, I had this article with a lot of charts here. This was kind of like Trump's first 100 days in charts. And I just thought that this showed some very interesting things here. So, executive orders in the first 100 days, 142 executive orders, much larger than anybody else in history. Again, very interesting. This is major policy areas challenged in court. You could see just an unprecedented number of things challenged in court. You can see we have allowed, temporarily blocked / allowed, temporarily blocked, and then temporarily allowed, and then decision pending. A lot of interesting stuff in there. And then a lot of economic factors here. Obviously, you can see here from the S&P 500 Liberation Day, when everybody had this conniption, it was going to, everything was going to end. Global reciprocal tariffs paused, but then we could see here, wait for it. The market has bounced back, and we're almost back to where we, basically fell off from Liberation Day. So core inflation, again, going right on down. That's great. 10-year Treasury bond has come down. The 10-year rate has come down a little bit, sitting around about 4.3%, but we would really like to get that back into the threes. That would be great. New non-farm jobs created. Obviously, March, we know that 228 number is not correct. That was revised down to 185, which puts it more in line with this trend of 111,000, 117,000 we've seen here. Manufacturing investment. This is huge. Look at this. Like I said, in tech, $1.6 trillion in investment coming up here. And this is what Peter Navarro was talking about with the GDP number, what I talked about earlier. So you can see here, automobile, 46 billion, pharma, 105 billion, other 2.7 billion. So huge amount of investment coming down the road here. Illegal border crossings were, obviously record number, way down. Love to see it. Taxpayer savings, 1.6 billion per day. So again, that's great. That's great. Love to see it. So, staff reduction. I kind of covered this last week when I showed like the Doge charts, so I'm not going to really jump into all that. But again, just some interesting things I thought I would show everybody. I thought people would find some of that interesting. Eric Trump gave this interesting interview this week where he said, if banks don't watch what's coming, they'll be extinct in 10 years. So basically saying that, the modern financial system is broken, it's slow, it's expensive. Eric Trump told CNBC at the UAE The executive vice president of Trump Organization has made frequent visits to the desert sheikdom in recent years as it rapidly becomes a global hub for cryptocurrency. A vocal advocate for digital currencies, the younger Trump lauded decentralized finance as a way to bypass the costs and lack of privacy of traditional banks. All I'm going to say to this is that I have heard all this before. I've heard this argument before. I mean, I've been in banking for 25 years. I've heard it all. I have heard that, oh, every 2 years the branch was going to be dead. The branch was going away. The branch was never to be heard of. The internet was going to kill banks. Web 2.0 is going to kill banks. Social media was going to kill banks. Everything is going to kill banks. Okay. And yet here we are, still standing strong. And there's a reason for that. There's a reason for that because a bank charter, a license to run a bank, gives the bank highly unusual powers that nobody else has. And that will never change. And that's what will keep banks in business. That was what will keep banks around for a long, long time. So again, interesting article, interesting take. I'm not buying it. You can argue certainly banks could change in different ways. I wouldn't argue that, but are banks going to disappear? No. Okay. Bank Drive, interesting article here. I just wanted to point out. So the CFPB has had all this legal wranglings going on right now about whether the government could fire basically the majority of CFP employees, 1,483 persons to be exact. But basically, so an appeals court backs the injunction barring the CFPB mass firing. So the Bureau's 1,483 person reduction will remain halted through May 16th. A 3-judge panel walked back language concerning particularized assessments of employees' necessity, and 1 judge dissented. So a federal appeals court on Monday restored a district judge's temporary injunction barring the CFPB from proceeding with any mass firings. Specifically, the U.S. Court of Appeals for the District of Columbia Circuit walked back its stay that allowed agency leaders to terminate employees who had been determined after an individualized assessment to be unnecessary to the performance of the defendant's statutory duties. Less than a week after the appeals court issued its April 11th partial stay, the CFPB rolled out a reduction in force encompassing roughly 90% of the Bureau, a move the district judge again halted before it could take effect. So this battle, far from over, is going to continue to play out in the courts. Ultimately, though, I don't think that this is going to change. I think ultimately, whether this takes a month or 3 months or 6 months or a year to work its way through the court, these 1,483 people are going to be out of job. The CFPB is going to be massively reduced. And whether or not the CFPB can be totally, taken out, I don't know. We'll have to see. But like I said, more to come here. I just wanted to point out. I just wanted to tell everybody, hey, this is the status. This is what's going on. Okay, this was wild. I saw this. Homeowners insurance has risen over 50% in these states. The skyrocketing price of insurance premiums is deepening the housing crisis, cautions the Consumer Federation of America. So homeowners insurance rates have risen dramatically from the average of $2,656 annually in 2021 to $3,303 in 2024. That's a 24% increase, more than twice as fast as of the rate of inflation in the same time frame. But the increases hasn't been uniform. According to a new report from the Consumer Federation of America, some states have been harder hit than others. So let's look at these top 5 states here. So top 5 biggest increases were in Utah, 59%, Illinois, 50%, Arizona, 48%, Pennsylvania, my home state, 44%, Nebraska, 35%. And yes, I can attest to this personally, that I have seen my homeowner's insurance. I have been in my house a long time. I've never filed a claim, and my insurance premiums have skyrocketed in the last 5 years, and it's unbelievable. And this is a big problem. This is a big problem and needs to be addressed. I would just love to hear from the insurance companies what's going on here. Why are they? I mean, are these increases being perpetrated to pay for environmental disasters that have gone on, like what's happened in Maui, what's happened in California, what happened in North Carolina, Tennessee, and Georgia. Is that what's driving all this, or is this just price gouging? Was it inflation from a few years ago? Like what is exactly going on here? And I think we need a lot more information and a lot more explanation from these, big insurance companies as to what exactly is going on here. Obviously, this doesn't help with the affordability of housing. That is absolutely for sure. So we'll have to, see what's going on there. Okay, couple of interesting articles here related to some of our peer-to-peer payment apps. So Venmo, which is owned by PayPal. So what are the three major peer-to-peer payment apps? We got Venmo, which is owned by PayPal. We got Cash App, which is owned by Block. And then we have Zelle, which is owned by Early Warning Systems, which is basically owned by all the big banks. So Venmo revenue grows 20% with debit card payment volume soaring. So PayPal said Venmo revenue grew 20% year over year in the first quarter, doubling the pace of total payment volume growth. Analysts from Jefferies and Compass Point flagged Venmo's momentum in branded checkout and debit cards as a key opportunity, despite rising competition from Zelle and Square's Cash App. PayPal added nearly 2 million first-time PayPal and Venmo debit card users during the quarter, with a total debit card payment volume climbing more than 60%. So remember when I said earlier about I did the episode yesterday on the NACHA first quarter 2025 ACH network report and some of the statistics. Well, that's part of why I do this, because I look at what's called the peer-to-peer, the P2P payment volumes. What's happening with that? And that's where I come in with this. So again, PayPal looking good. However, how is Cash App? What is Cash App looking? So Block plunges 20% as Cash App triggers downgrade. So Block shares were on track for their second worst day, plunging more than 20%. This was yesterday, after a brutal quarterly report and a wave of analyst downgrades. Analysts flagged fresh concerns around stagnant Cash App user growth, muted consumer demand, and a soft macro environment that may weigh on monetization. Monthly Cash App activities remained flat at 57 million, and inflows rose just 8% despite new features like Afterpay on the Cash Card. So again, just some interesting things I wanted to point out. So Venmo seems to be doing great, but Cash App not doing so hot on the other side of things. So just again, interesting things to point out here. Okay, then I got a couple student loan things. So federal student loan collections to restart in May after the Biden era refreeze. So the loan repayment push aims to stabilize the 1.6 trillion federal student loan portfolio and reduce taxpayer burden amid rising delinquency. And then we look at, what was this article here? So upcoming collections could make student loan borrowers' financial situation worse. According to the Department of Education, 5 million borrowers have defaulted on their federal student loans and 4 million are currently delinquent. The Department of Education plans to resume wage garnishment on defaulted borrowers this summer, making it harder for borrowers to make other payments. Collections and lowered credit scores will make taking out new debt harder and more expensive for defaulted student loan borrowers. Republicans release plan to overhaul student loan system, slash repayment plan options. So House Education and Workforce Committee Republicans have released their plan to overhaul the country's student loan and financial aid system. The Pell Grant eligibility would come with new requirements, and student loan borrowers could see their repayment plan options dwindle. Okay. So what I would say on this, I think Republicans are really barking up the wrong tree here. Do people need to repay their student loans? Yes, absolutely. I think what Biden was trying to do with trying to forgive a lot of these student loans was disgusting, because it had nothing to do with helping out the students. It was him trying to buy votes. Okay, that's plain and simple. He was trying to buy votes. He knew that he wouldn't get it through. The Supreme Court shot it down, said you couldn't do it. He went ahead and did it anyway. I think he still tried to forgive $400 billion in student loans. So he still went ahead and tried to do it anyway, even though the Supreme Court told him, no, you can't do that. And like I said, I think ultimately he knew he wasn't going to get it, but he was trying to buy votes, and it was horrible. He set a horrible precedent. But now, again, I do sympathize with the position that some of the people with the student loans are in. It's hard. They're trying to figure out. They're trying to do it. It's not that I think for most of them, it's not that they don't want to pay. They're struggling. They're struggling with it. And taking away the payment options and basically dropping a hammer on them, I don't think that's the right approach. I don't think that's going to help you out here. Do reforms need to be made? Yes, absolutely. But reforms need to be made with the entire college system itself, and the whole financial aid system itself. And the reforms need to be made with colleges, with the student loan servicers like Navient, like all these student loan servicing companies. There's a whole lot of stuff that needs to be changed here. I just think that I think they're barking up the wrong tree here. I think they're being way too over the top, and I think they need to probably back up on this a little bit here. So, okay. Last couple articles here tonight, guys. Altman and Nadella. All of a sudden, we've got some trouble in paradise here. So Nadella, obviously the CEO of Microsoft, these two ignited the modern AI boom together, and now they're drifting apart. I might have done an episode about a week ago all about how Sam Altman got fired at OpenAI, and about how Nadella ran to his rescue and got him the job right back. And now they're beginning to drift apart. Could it be that all the things that were highlighted in that episode about Altman and his lying, his scheming, his double dealing, his underhandedness, his total lack of ethics, could that be at issue here? Maybe. So the OpenAI and Microsoft CEO helped each other become power players in generative AI, but are now preparing for independent futures. So Microsoft and OpenAI's partnership, once strong, is now strained due to disagreements over computing power and access to the startup's models. One area of tension is OpenAI's development of models with human-like intelligence functionality Altman has said his team can build soon, but that Nadella has downplayed. OpenAI and Microsoft have power over each other's futures plans. So yes, if you're going to get a divorce here after Microsoft has already put $14 billion into OpenAI, that's what you're going to call, that's going to be an uber messy divorce here. Uber messy divorce. Now, I'm not going to get into this whole thing. I will probably come back and cover this more later on. But yeah, trouble in paradise here, everyone. Trouble in paradise. Here's another Sam Altman thing. Sam Altman's eye scanning ID project launches in the U.S. with 6 locations. This company is called World. World is opening 6 U.S. retail locations for eyeball scans: Austin, Atlanta, Los Angeles, Nashville, Miami, and San Francisco. The Orb, a spherical biometric device, scans your face and iris, then creates a stored and unique iris code for you, verifying that you're a human. World announced 2 high-profile partnerships with Visa and Match Group, the online dating giant. I for one can't wait to do this. This doesn't sound scary at all. This doesn't sound like this could turn into something horrific, right? Oh my God. Who in their right mind would do this? I have no idea. Just this just sounds terrifying. This sounds like George Orwell on steroids right here. Like, I can't even. Yeah, this is just, I hope that people are not stupid enough to go do this. I'll just leave it at that. Okay, and then the last thing I got before we'll do our story and quote of the week is, this was a very interesting article. 110-hour work weeks drove young bankers at a boutique firm to the brink. Junior bankers at Robert Baird said such long hours were not unusual for industrial teams. So a Wall Street message board post about demanding work conditions at Baird went viral this month. Working more than 110 hours a week was not unusual, former employee said. After the post, senior bankers convened a town hall and encouraged juniors to come forward with concerns. So it basically was like, yeah, come tell us your problems, and then we're just going to tell you to go back to work. No, in all seriousness, something that has happened. So over the last year, you had a couple young bankers, investment bankers, young junior employees basically died. And part of the issue at hand is this culture of these, kind of ridiculous work hours. This, working them 110 hours a week, working every day, 7 days a week, not really giving them any time off and doing anything. Now, and I said I tried to make a couple of points on this. Number one was, this is nothing new. This has been going on for decades. And this is part of the gig. Hey, look, you want to go for the golden goose, you want to make millions of dollars, you want to basically you want to work from the time you're 22 and by the time you're 32, you want to work 10 years and basically be a multimillionaire when you're done. Well, guess what? As they say, there's a price to be paid for everything in this life. And your price, if you want to become stupid rich within 10 years, is you're going to work 110 hours a week and you're going to work like a dog. That's been the trade-off. It's not work 110 hours a week and make $100,000 a year. No. This is work 110 hours a week and make $1 million a year. That's what's going on here. That's the part that they're leaving out here in this. And so again, I'm not saying it's right. I'm not saying that these guys should work 110 hours a week. I'm not saying that. I'm just saying that there's more to this story than may be what meets the eye or more than just what's on the surface here. So, so again, interesting story. I'm going to continue to follow this and we will continue to see what happens here. So, okay. With that, I'm now going to go into my two standard things that I do to wrap up every week. I'm going to do to my story of the week and my quote of the week. So let's go. Let's do the story of the week first. So the story of the week is the Securities Exchange Act of 1934. The Securities Exchange Act of 1934, otherwise known as C, was created to govern securities transactions on the secondary market after issue, ensuring greater financial transparency and accuracy and less fraud or manipulation. The C authorized the formation of the Securities and Exchange Commission, or the SEC, the regulatory arm of the C. The SEC has the power to oversee securities, stocks, bonds, and over-the-counter securities, as well as markets and the conduct of financial professionals, including brokers, dealers, and investment advisors. It also monitors the financial reports that publicly traded companies are required to disclose. It also enhances corporate reporting standards and authorized the SEC to regulate brokerage firms, clearinghouses, and exchanges, and enforce new rules governing proxy solicitations, tender offers, insider trading, and margin requirements. All companies listed on a stock exchange must follow the requirements outlined in the C of 1934. So there you have it, everyone. The act that ultimately created what we now know as the SEC, the Securities and Exchange Commission. So the Securities Exchange Act of 1934. Okay, so now what is our quote of the week here? So our quote of the week is, imagination is more important than knowledge, for while knowledge defines all we currently know and understand, imagination points to all we might yet discover and create. That was from Albert Einstein. So with that being said, thank you so much for listening tonight. I hope everyone has a wonderful and great weekend out there. Remember, please subscribe, as that really helps the channel. I'm really trying to make a bigger push here for obviously more viewers, more subscribers would be great. But please make sure you like, share, and subscribe. That always helps us. Make sure to share the content that you're seeing. If you're liking what you're seeing out there, leave me some comments, as I always love getting back to everybody. Stay tuned. I've got a lot of great things, I think, coming up the rest of the year, as far as like interviews, book reviews, special different reports and things that I'm working on. So I a lot of great things I got coming up here over the next 4 or 5 months, and I think a lot of things people will really like. But like I said, but until then, be back next Saturday night at 8 o'clock for another live stream. Come back, be back in the strategy room. I hope to see everybody then. Have a great weekend. Take care. I'll see everybody again real soon. Thanks a lot.